Welcome back, wealth builders, entrepreneurs. Michael Rosmer here with Richucation. This is not an investing course, so we're not going to go into deep nuances of investing, but we're going to talk right now about the different types of asset classes and kind of what sets them apart, okay? So we're starting off with the asset class of real estate, okay? So each asset class, real estate, has its own characteristics, and we're going to cover the major ones: real estate, commodities, bonds, and companies, okay? Lots of variation within there because there's different types of real estate, right? So you've got commercial, residential, multifamily residential, industrial, farmland. Those are kind of like the main ones. But then we get into like, are we doing development? Are we doing, renovations, condo conversions, all this kind of stuff. Lots of different variation we can get in real estate. But what makes real estate, because here's this concept. We need to understand what asset classes have what characteristics and how they're going to be affected by certain market conditions, etc. Okay? So, to start off with, we are going to recognize that real estate is no growth, but productive. Okay, so but productive. Okay, what does that mean? Well, the thing is that how is real estate going to grow? Real estate really can't grow. You've got what you've got. You're gonna, you can't really, you can renovate, of course, you can do all those sorts of things, but that's not as an investment, that's as the business of real estate. Okay, so we're just talking about the investment of real estate. The quality of it is that it doesn't have growth. Okay? So, but it's productive, meaning that it produces cash flow every year, unless it's just sitting idle. Okay? So that's a very important starting point to recognize. What's the next thing that we have? Well, as we mentioned before, there is ease of operation, right? Ease of operation. So real estate, you can do pretty good returns in real estate as a set and forget investment, okay? Which does a lot better than many things, okay? So that's very important. What else have we got? So you need to understand how it's affected by inflation, okay? And it's mostly inflation adjusted, okay? So mostly inflation adjusted. Now why do I say mostly? Because you might be in a position where you've got things like rent controls, okay? And you could have long-term leases. Long-term lease. Okay? Both of those things are going to interfere with, so over the long term it's inflation adjusted. If you have sudden bursts of inflation, that could be very bad for you, because now you've got somebody on a 5-year lease who doesn't have, your expenses might have gone up because, say maybe you're including the utilities in it, right? So your taxes are going up, you're in a position where it's like, okay, you're paying higher for utilities, you're paying higher for maintenance, etc., but your rental income hasn't increased, okay, because of these two things. That would be a problem, all right? But overall, rents should follow inflation, and the asset value will tend to follow inflation, okay, because the construction costs will go up, and as a result, the real estate will go up, okay? What else have we got? Well, I have like some notes about, okay, so what are some of the risks? What are the things that are going to adjust the value, okay? There's two key things in the broad market, and then we're going to talk about the narrow market. So we have inflation, okay, and interest rates. And of course, as we discussed earlier, it's not actually just interest rates, it's also lending rules. Okay. All right. So, by the way, it is the worst asset, typically, for deflation. Okay? So, awful deflation. Okay, so deflation is when all the prices are going down. Why is real estate the worst? Because it correlates with inflation, but because of the fact that it's leveraged, usually real estate's highly leveraged. There's a lot of financing to the asset value, okay? So by comparison, let's say we were talking about, I don't know, we were playing the game with stocks doing margin accounts. That's 50% leverage, okay? So that's not good for us, but it's not nearly so bad as if we're 80 or 90% leveraged, okay? So that's useful to note. Now, so let's see here. Did we talk about this? So, okay, how does inflation obviously, goes up. So everything goes up, which includes the rents. And when the rents go up, that drives the prices up, basically. Okay? Which, by the way, let's talk about this just briefly here about how the building works. Okay? So, actually, we'll go into that in just a second. Interest rates. How do interest rates affect this? This is something that a lot of people seem to kind of miss. It's an important point, though. People will say, the prices have doubled. I'm going to use rough, not accurate numbers, but let's just say that a $300,000 property or a $250,000 property, okay, so $250,000, okay, at, let's say, I don't know, we'll call it 3% interest over 25 years, okay, so times 25 years. The total real price paid, so once you include the interest, the total real price paid is, let's say, twice that. Okay, so it's not going to be that, but let's just say that's the total amount. Okay, $500K. So people will look at this price and they'll say, property's $250K, right? But let's take that same number, but say that it's at, 18% interest. Okay. Now, what's it worth? Now it's probably at least $750,000. It might be more. We'd have to run the math, right? But let's say, for the sake of argument, that it's 750. Okay, 750K. Okay. So, what people will do? Notice here, it's the same 25 years, the same purchase price. Okay. Now. So the real price paid is $750K, not $500K. Now let's flip this around. Okay, let's say that we're in a falling interest rate environment. So as an example, interest rates peaked in North America in the early 80s. Okay, they've pretty much come down since then. Well, let's say that you bought a property for the $250,000, okay, at the 18% in the early 80s. Okay? So what we're saying is that the real price was $750,000. Okay? Let's say that 10 years later, the interest rates have dropped to 9%. Okay, so they've been cut in half. And this property is now, instead of being $250,000, it's $500,000. Okay, so it's doubled in 10 years. Right? You're like, wow, I got a good return on my money. I just doubled my money in 10 years. That's great. And you got better because of leverage, right? So, did the value of the property really double? No. Why? Because $750,000 was based, so the real price was $750,000. The after interest price of the $500,000 at 9%, say, is probably like $1 million. Okay, let's just say that was the number. Maybe it's a little bit more, maybe it's a little less, it doesn't matter. The whole point is, what really happened is it really went up in real after interest terms, okay? So after interest equals not 100%, but instead let's say it grew by 50%. Okay, just for the sake of argument, 50%. All right? Still, you grew by 50%, that's great, but not nearly as much. Okay, so in that case we would have had $3,750. And so whatever, we get, let's see, we add 300,000 to that, so it's so we're talking about 1.125, okay, million. That's the difference, okay, and people miss that. And why does this happen? Why do interest rates falling drive up prices? because a person's payment goes down. So what they can afford, people don't pay for a house outright. They pay for a payment, right? So let's say that I have $1,000 a month to spend, okay? That's my budget, 1,000. Well, if at 3%, that allows me to buy a $250,000 house, okay? Then great, it's $250,000. But let's say that instead I'm at 12%. That same 12% might allow me to pay only 150,000. Okay? So as that interest rate goes down, my payment stays the same, so I can afford to buy something more expensive. So I'm going to be willing to bid on something more expensive, which people are going to compete for. Okay? That's how come. So payments. Okay? Payments. That's also how come amortization period matters. Okay? Amortization, which is the length of the loan, right? So if it's 25 years, if we're capped, okay, we can only get a 25-year mortgage. Well, how much is our payment going to be? Versus if I can get a 35 or a 50-year mortgage, right? If I can get a 50-year mortgage, I'm going to say, oh, I can buy something bigger because my payments are the same, right? I budget based on my payments. Very, very big deal, okay? Another example might be, what down payment do I have to include, okay? Down payment. If I have to put a larger down payment, what's that going to do to real estate prices? It's going to put a downward pressure on them, right? Because now, what's my affordability? See, we're caring here not about cost, not cost, but affordability. Okay? So as wages go up, my affordability goes up, etc. It's not all about affordability, but that's a big part of it, right? Of course, people will still, if they can get something for less, they'll still get less. It's not like because they have more money, they're going to automatically spend more money. But what it's going to do is it's going to put more money into the system, which allows people to bid more, which allows other people to outbid them, etc., right? So that's what we want to pay attention to when we're talking about the macro effects. Okay, we want to realize how macro affects real estate prices. Okay, macro. What else have we got? Well, another example of what might happen, which interestingly, a Ray Dalio point. It's not just because interest rates are low. If prices are going up, that tends to drive prices up because then people get into speculative bubbles, right? So that's another piece to consider. Okay, next, let's change our color here. Long-term, what do we have to consider? Okay, long-term values. Long-term values are going to be based on two things, okay? Based on rents and construction cost. Okay? So as rents go up, then so too will the value of properties go up. Not immediately, right? But here's why. Well, let's say that I can get a 3% cap rate. 3%. It's really bad, right? Hard to make any money at that rate. But then rents go up quite a bit, okay? So there's not many people buying real estate as an investment because, and likewise, there's not that many people who are, there's a lot of incentive for people to rent when cap rates are 3%. There's not a lot of incentive for people to buy, okay? But let's say over time rents go up so that cap rates are now 10%. Well, what is that going to do? That's going to provide an incentive for people to buy instead of rent, and it's going to provide an incentive for investors to come in, and they're going to be able to go because they can get a higher return, right? Capital wants to grow where you can get a better return, you're going to put your money in the macro, right? So as a result, rent is the driving factor. What's going to drive rent is going to be supply and demand. Demand is primarily going to be the thing that's going to change, and that's going to be usually in migration, which is usually driven by jobs. Not entirely, it might be driven by a whole bunch of other things, but that's typically the case, okay? Then we've got construction cost. Okay, how does construction cost work? Well, if the construction costs are substantially lower than the current price, then we will tend to build. Okay? So, construction costs lower, we want to say substantially lower actually. Substantially lower than price, then we'll build. Then building, okay? And what will building do? Building will provide additional supply, which will drive prices down, provide price stability, right? Drive rental yields down, because now there's places that are like, we want to fill them, so we're going to go with lower rents, right, to attract people to come in. So when those people come in, what's going to happen? That's going to drive everybody else's rental prices down to compete, right? So it kind of, now, it's not going to be macro, like it's not a massive fluctuation, because usually you're not going to flood the market with new supply. It takes a long time to build houses. You're not going to price it that much below market rents. It's probably going to be like, maybe it's like $50 a month less or something, On the flip side here, right, if prices are much lower than construction, no build, or less building, whatever. And you can just think about this logically. Well, the construction companies, the companies building houses, want to make a return on their money, okay? So if all these properties are selling for way higher, there's like a big incentive to go out there, like, let's build. Oh yeah, we can make $100,000 off every house. Let's build a ton of those things. $200,000 off of each condo? Holy man, do that, lots of it, depending on what the return on capital and all that kind of stuff is, right? So, big deal. Now, if we're talking about the flip side, if we say, well, all of these houses are selling for way less than construction cost, okay? There's still a differential because people like new stuff, but for the most part, you're not going to be able to sell those houses for as much, and as a result, there isn't the incentive to build them, right? Which means you're not going to have as many until it fixes itself up. Okay, so that's the key that we need to pay attention to with respect to our long-term pricing model. Okay? The other thing to note about real estate, that's very useful, is it's tax advantaged. Okay? Tax advantaged. And it's tax advantaged in a couple ways. One is that it's deferred. Second is typically you're going to sell it, it's going to be capital gain, which is tax favored. And you're also going to end up in a situation where not only is that the case, but you've also got potentially the ability to refinance it, pulling the money out without having to sell it, which means not having to pay tax again. Or like say in the US, you can do a 1031 exchange potentially, where you sell it and you can roll the money into another purchase without having to pay tax. Some places your primary residence, you don't have to pay tax, or you don't have to up to a certain level, etc. Okay, so all things that are very useful to know and understand. So this is real estate, okay, in a brief little nutshell that gives you a super high level. Obviously, again, this is not a course on investing. It's to give you an understanding of the asset classes so that you can figure out where they fit into your overall picture. Okay? So with that in mind, if you want some support and assistance on this, we're happy to help you. Real estate's really fun. Investing is really fun. Business is really fun. I love it all. Reach out to us. Join the action classes, guys. If you haven't joined, sign up right now. I'll see you guys on the next video.